Hello everybody, this is AK. I'm back. I'm sure most of you would remember my many videos on why I think that investing in the banks makes more sense than investing in REITs in current day environment. Right, I've been saying this for many months, right? More than a year probably, and I haven't added to my investments in REITs in all that time. And of course, I also made a video on if we should be selling our investment in the banks and buying REITs because banks share prices have gone up so much, whereas REITs the prices are still in the doldrums. And of course I said I'm not doing that. It's a mistake to just look at prices, right? And that we should be looking at the fundamentals. We should be looking at what the banks bring to the table and what REITs bring to the table. And I'll leave links in the description box below to several of those videos. And for those who are new to my channel or might have missed those videos, they can go and take a look. And I also said in another video that I rather invest in a business that will do well in most circumstances and in all circumstances when it comes to interest rates. And I said that the banks fit the bill because they do not rely on a single source of income. And I know because net interest income was something that's very much in the spotlight, with interest rates expected to come down a bit more. And at one stage, the interest rates were expected to come down a lot more because the Fed gave a forecast of how many rate cuts there might be in 2025. And they have backpedaled on that forecast, and they say there will be fewer rate cuts in 2025 now. Right, but I say the banks will continue to do well because net interest income isn't their only source of income. Right, and wealth management fees have come in very strong and is expected to continue growing at a double-digit percentage point, and whereas net interest income is likely to come in a bit weaker, but expectations for more people or more businesses to take up loans because interest rates are lower and becomes less prohibitive to take on loans. So overall, I say the banks will still make money. The banks always make money, and even if interest rates come down, as long as they come down gradually and they don't come down all of a sudden in a huge wave, the banks will continue to do well. Whereas for REITs, it's more binary, right? Because their only source of income is rental income, and unless they can increase that income, that means they have rental reversions which are much larger to make up for the higher costs of doing business, and that's the financing cost. They are likely to continue to plod along, not doing very well, and in some instances they will suffer, right? Those REITs which are highly leveraged, their balance sheets are weaker, and they have a lot more refinancing to do. And also those REITs which have a lot of their debt on floating rates, they will continue to experience some hardship in an environment where interest rates are expected to stay higher for longer. Right, so I would rather invest in the banks which are, their fortunes are less binary in nature, whereas the REITs, they really depend on, to a large extent, on interest rates and where they are going. And of course, Mr. Market has reacted in a way that is not unexpected, right? With Donald Trump having won the presidency and his policies being very likely to be inflationary, which means interest rates are very unlikely to come down by a lot in 2025. REITs are being punished. Not just in Singapore, they are being punished everywhere else in the world. They are being punished in the USA as well, right? Of course, that's their home turf, right? Interest rates stay higher, it's bad for the US REITs. And Singapore REITs have suffered from, what do you call that? Collateral damage. Suffered collateral damage, right? But it's not really collateral damage because they are going to be impacted directly as well, since we in Singapore import our interest rates from the US, right? So what's the point of this video? The point of this video is to tell myself that there is nothing for me to do in 2025. Okay, so people who are eavesdropping, they know what I'm trying to say, right? If they have a similar situation as what I have right now, that means very heavily invested in the banks and not so heavily invested in the REITs, or not so heavily invested in a very highly leveraged entities, right? But heavily invested in the banks, right? And that is I'm telling myself I should hold on to my positions in the banks because it will continue to do well, and I will continue to enjoy meaningful passive income. And whereas the conditions which are good for the banks, well, the conditions are less benign for REITs and other highly leveraged entities. Unless financial conditions, they go back to what we saw during the pre-COVID years or the post-global financial crisis years, the 15 years of very low to interest rates or zero interest rates, the 15 years after global financial crisis. REITs are likely to not do so well, right? And which is why I've stayed away from adding to my investment in REITs. But like I said, all investments are right investments at the right price. So there will come a time when possibly we can invest in REITs for better returns again. But for now, it's probably just subpar returns. And I shared my view of when that time might be. And that's, if and it might not all come at the same time, right? I mean, if a REIT, all else being equal, should offer a distribution yield of, let's say, 10%. And a REIT distributes all its income to achieve the distribution yield that they offer to investors. A 10% distribution yield is actually pretty attractive, right? All else being equal. Because if we look at the banks today, at their elevated share prices today, I always say we should look at earnings yield and not just at the dividend yield. Now, if we look at the earnings yield of the banks today, it has come down, right? Not 10% anymore, or higher than 10%, like what I used to say months ago, before the most recent jump in share prices. Earnings yield is about 9%. Right, so if we look at a bank's earnings yield 9% and REITs being able to offer a distribution yield of 10%, I think they are really good choices, both of them. Right, so like I say, it's not static, it's always dynamic, right, when it comes to investing and it comes to valuation. So, and it's very myopic to just look at dividend yield, because if we look at the dividend yields from the banks today, so you say, oh, it's only 4-point-something% now, it's not very high, like 6-point-something%, 5-point-something%. It's only 4-point-something% now. It's very myopic. We have to look at the dividends yield. Some people say, oh, 4-point-something% that hardly keeps pace with inflation. No, if you look at earnings yield, you get the full picture. Then you realize that the investing in the banks beats inflation even at today's prices, because the earnings yield is almost 10%, is in excess of 9%. That beats inflation easily. It beats it flat, right? And if we are worried about inflation, well, I think if we're invested in the banks, there's very little to worry about our wealth being eroded away. Don't just look at dividend yields, look at earnings yields, right? So it's something I thought of just now, and I thought it's important and safe enough to share. I'm not providing any financial advice. I'm just sharing my perspective, sharing my thoughts here, right? Remember that. And so if AK can talk to himself, so can you. Bye-bye.